Hey everyone, and welcome back to the Deep Dive. Today we're going to take a deep dive into mutual fund investing in India.
We've got a ton of great resources here that are going to help us understand this topic.
Yeah. And we're going to make it easy for you, like giving you your own personal Cliffs Notes for mutual fund investing.
We're going to guide you through the important stuff so you can make informed decisions about your investments.
Exactly. So I was looking through everything you sent me, and one thing that kind of jumped out at me was all this stuff about KYC. It sounds kind of mysterious, like something out of a spy movie.
It does have that kind of vibe, doesn't it?
Yeah.
KYC stands for Know Your Customer.
Ah, okay.
And it's essentially a one-time identity verification process that's mandatory for all investors in India.
So it's not just for mutual funds.
No, not at all. You'll run into it for pretty much any kind of investment you make in India, like stocks, bonds, even opening a bank account.
So it's like a basic requirement for entering the investment world.
Exactly. Think of it as getting your investor passport stamped. It's all about making sure everything is transparent and above board.
And preventing any financial shenanigans?
Precisely. And there are regulations like FTSI and UBO that play a role in this too. They might sound intimidating, but they're basically there to ensure a level playing field for everyone.
Okay, so KYC is like the first step. But once we've got that sorted, how do we even begin to choose the right mutual fund? I mean, looking at this list, it's like walking into a giant supermarket with 20 different aisles of cereal. Where do you even start?
It can definitely feel overwhelming. But don't worry, we're here to break it down for you.
Okay, good.
There are three key things you need to consider.
Okay.
First, your risk appetite. How comfortable are you with the ups and downs of the market?
Yeah, because investing isn't like stashing cash under your mattress. There's always some level of risk involved.
Exactly, and different mutual funds come with different levels of risk. For example, equity schemes, which invest primarily in stocks, tend to have higher potential returns, but they also come with higher risk.
So it's kind of like choosing between a roller coaster and a carousel.
That's a good way to put it. And then the second thing you need to think about is your expected return. How much do you want to gain from your investment?
Right, because everyone wants to see their money grow.
Of course.
Yeah.
But it's important to remember that returns aren't guaranteed.
Oh, right. It's not like a savings account.
Exactly. They depend on a whole bunch of factors, mainly how the market performs.
So it's like setting sail on a voyage. You can't really predict the winds or the currents.
That's a great analogy. And then the third key factor is your time horizon. How long do you plan to invest for?
Okay. So are we talking like a few years, a decade, or even longer?
It all depends on your goals. If you're saving for a down payment on a house in a few years, you might choose a different type of fund than if you're saving for retirement decades from now.
Right, because a shorter time frame might call for a less risky approach.
Precisely. You wouldn't want to invest in something super volatile if you need the money in a year or two.
Makes total sense. So we've got risk, expected return, and time horizon.
Those are the three musketeers of mutual fund selection.
I like it.
Yeah.
But even once we've kind of wrapped our heads around those things, how do we actually pick a specific scheme from a particular asset management company or AMC?
That's where the real detective work comes in. You'll want to look at the AMC's track record. How have their funds performed in the past? Are they consistent performers or more like a roller coaster ride?
And I guess you'd also want to look at the fund manager, right? Like how experienced are they?
Absolutely. You're not just looking at the car. You're also checking out the driver's license. And speaking of cars, you also want to peek under the hood and look at the expense ratio.
Ah, yes, those pesky fees.
Lower is generally better because it means more of your money is actually working for you.
It's like paying a toll on the investment highway. Okay, so let's say we've done all our research, we've narrowed down our choices, and we're ready to take the plunge. How do we actually apply for a mutual fund these days? Do we need to like show up at their headquarters with a briefcase full of rupees?
Thankfully, no. Things are a lot more streamlined now. You've got two main options.
Okay.
The traditional offline route where you fill out physical forms,
Right.
or the increasingly popular online method.
Ah, online investing. So much easier.
It is super convenient. But no matter which way you go, you'll need to have your bank details handy because that's where any redemption proceeds will be sent.
So like if you decide to cash out your investments.
Exactly. And here's something important to remember. As of April 2023, nominating a beneficiary became mandatory.
Oh, really?
Yeah. Basically, you need to designate someone who would inherit your investments if something were to happen to you.
So it's kind of like writing a will for your mutual funds.
In a way, yes. It ensures that your investments don't end up in financial limbo.
That's a good point. So let's talk a bit more about the whole online versus offline thing. Is one really that much better than the other?
Well, with online applications, everything is digital. You can zip through the process, upload your documents, and get instant confirmation. It's like ordering a pizza online, quick, easy, and you can track its progress.
I love ordering pizza online.
No.
It's definitely the more modern approach. But with offline applications, you'll need to physically visit the AMC's office or a designated point of acceptance, fill out forms, and submit them along with the necessary documents.
It's a bit more old school.
It is. But some people still prefer that personal touch.
So it really comes down to personal preference.
Exactly. You choose the path that feels most comfortable for you.
Okay, great. So we've covered a lot of ground here.
We have.
We've talked about KYC, choosing a fund, even how to apply. But there's still so much more to explore.
There is. In the next part, we'll dive deeper into the different types of mutual fund schemes, from equity to debt to hybrid and everything in between.
Sounds good. I can't wait to learn more. Join us next time for part 2 of our deep dive into mutual fund investing in India.
We'll be here. And remember, investing in mutual funds doesn't have to be complicated.
That's right. Thanks to this deep dive, I feel like I've gained a much better understanding of how mutual funds work and how I can use them to reach my financial goals.
That's what we like to hear.
I'm sure our listeners are feeling the same way.
Hopefully they are.
Well, that wraps up another exciting episode of The Deep Dive. Thanks for joining us.
Until next time.